From the time of ancient civilizations to the modern era, gold has been the world's currency of choice. Today, investors buy gold mainly as a hedge against political unrest and inflation because of gold's low correlations with other asset classes. In addition, many top investment advisors recommend a portfolio allocation in commodities, including gold, in order to lower overall portfolio risk. There are many opportunities to invest in gold, including bullion, mutual funds, futures, mining companies, and jewelry. With few exceptions, only bullion, futures, and a handful of specialty funds provide a direct investment opportunity in gold. In this video, I will explain how you can invest in gold, and if you are a beginner, so you are at the right place, stay tuned and watch the whole video. Let's start. Gold bullion. This is perhaps the best-known form of direct gold ownership. Many people think of gold bullion as the large gold bars held at Fort Knox. Actually, gold bullion is any form of pure or nearly pure gold that has been certified for its weight and purity. This includes coins, bars, and other forms of gold of any size. A serial number is commonly attached to gold bars as well, for security purposes. Gold coins. For decades, large quantities of gold coins have been issued by sovereign governments around the world. Coins are commonly bought by investors from private dealers at a premium of about 1% to 5% above their underlying gold value. But in recent years, the premium has jumped to around 10% in some cases. Gold ETFs and mutual funds. One alternative to a direct purchase of gold bullion is to invest in one of the gold-based exchange-traded funds. Each share of these specialized instruments represents a fixed amount of gold, such as 1/10 of an ounce. These funds may be purchased or sold just like stocks, in any brokerage or individual retirement account. This method is therefore easier and more cost-effective than owning bars or coins directly, especially for small investors, as the minimum investment is only the price of a single share of the ETF. The annual average expense ratios of these funds are often around 0.57%, much less than the fees and expenses on many other investments, including most mutual funds. Many mutual funds own gold bullion and gold companies as part of their normal portfolios, but investors should be aware that only a few mutual funds focus solely on gold investing. Most own a number of other commodities. Are you still watching my video? So defiantly you will like my other videos as well. If you are interested in stock market or investing, and you don't subscribe to my channel yet, so subscribe right now because I upload these types of videos regularly. No individual company research needed. Some funds invest in the indexes of mining companies and others are tied directly to gold prices. Still others are actively managed. Read their prospectuses for more information. Traditional mutual funds tend to be actively managed, while ETFs adhere to a passive index tracking strategy and therefore have lower expense ratios. For the average gold investor, however, mutual funds and ETFs are now generally the easiest and safest way to invest in gold. Gold futures and options. Futures are contracts to buy or sell a given amount of an item, in this case, gold on a particular date in the future. Futures contracts are standardized and represent a predetermined amount of gold. As this amount can be large, futures are more suitable for experienced investors. People often use futures because the commissions are very low, and the margin requirements are much below traditional equity investments. Some contracts settle in dollars, while others settle in gold, so investors must pay attention to the contract specifications to avoid having to take delivery of 100 ounces of gold on the settlement date. Options on futures are an alternative to buying a futures contract outright. These give the owner of the option the right to buy the futures contract within a certain time frame, at a preset price. One benefit of an option is that it both leverages your original investment and limits losses from the price paid. A futures contract bought on margin can require more capital than originally invested if losses mount quickly. Gold mining companies. Companies that specialize in mining and refining will also profit from a rising gold price. Investing in these types of companies can be an effective way to profit from gold and can also carry lower risk than other investment methods. Gold jewelry. About 49% of global gold production is used to make jewelry. With the world's population and wealth growing annually, demand for gold used in jewelry production should increase over time. On the other hand, gold jewelry buyers are shown to be somewhat price-sensitive, buying less if the price rises swiftly. Buying fine jewelry at retail prices involves a substantial markup, up to 300% or more over the underlying value of the gold. Better jewelry bargains may be found at estate sales and auctions. The advantage of buying jewelry this way is that there is no retail markup. The disadvantage is the time spent searching for valuable pieces. Nonetheless, jewelry ownership provides an enjoyable way to own gold, even if it is not the most profitable from an investment standpoint. As an art form, gold jewelry is beautiful. As an investment, it is mediocre, unless you are the jeweler. Gold as a diversifier. Given gold's low correlation with other types of investment assets, investing in the precious metal traditionally has been considered as a hedge against economic downturns. In particular, gold's correlation with stock market performance has historically remained low, and gold tends to move in the opposite direction versus the dollar. This means that periods of dollar weakness could spell strength for gold prices. The potential benefits of gold as a hedge against declines in other asset classes may come to the forefront of investors' minds when facing the likelihood of a recession. Based on historical data, gold prices generally increase when inflation-adjusted bond yields decline. This suggests that there may be some wisdom in allocating a portion of your portfolio to gold as a cushion against rough patches for economic growth. After gaining so much information, I know now you have some questions in your mind like, what is the best way to invest in gold? How do beginners invest in gold? Is gold a good investment? So don't worry, I'm here to answer these questions as well. So stay tuned into the video, and if you like my effort, so don't forget to subscribe my channel. Now move on towards the topic. What is the best way to invest in gold? Finding the most suitable gold investment for your portfolio depends on your resources and investment goals. Larger investors looking for direct exposure may opt to invest in gold bullion, but this involves paying a premium in storage costs. ETFs and mutual funds that track the price of gold offer low-cost exposure with low minimum investments. However, because funds vary in their investment strategies and expense ratios, it's important to do your research before buying these shares. Investing in gold mining companies can provide another form of exposure to the metal, but these stocks don't always track gold's long-term performance very closely. Finally, buying jewelry can be a satisfying way to own gold, although it is less likely to generate investment profits. How do beginners invest in gold? Mutual funds and ETFs are generally the easiest and safest ways to invest in gold. Each share of these securities represents a fixed amount of gold, and you can easily buy or sell these funds in your brokerage or retirement account. Gold mutual funds and ETFs are a good choice for beginning investors because of their low cost and low minimum investment requirements. Is gold a good investment during a recession? Because gold historically has shown a low correlation with other types of investment assets, many investors include gold in their portfolios as a buffer against potential economic downturns. Gold prices generally increase when bond yields decline. While there may be benefits to investing in gold in a recessionary environment, its effectiveness during a recession or any other stage of the economic cycle will depend on how it fits into your overall investment strategy. The bottom line: larger investors wishing to have direct exposure to the price of gold may prefer to invest in gold directly through bullion. There is also a level of comfort found in owning a physical asset instead of simply a piece of paper. The downside is the slight premium to the value of gold paid on the initial purchase, as well as the storage costs. For investors who are a bit more aggressive, futures and options will certainly do the trick. But buyer beware. These investments are derivatives of gold's price, and they can experience sharp moves up and down, especially when done on margin. On the other hand, futures are probably the most efficient way to invest in gold, except for the fact that contracts must be rolled over periodically as they expire. The idea that jewelry is an investment is storied but naive. There is too much of a spread between the price of most jewelry and its gold value for it to be considered a true investment. Instead, the average gold investor should consider gold-oriented mutual funds and ETFs, as these securities generally provide the easiest and safest way to invest in gold. I hope now you understand how you can invest in gold if you are a beginner as well. So that's it for today. And if you will find my video valuable, so don't forget to like and subscribe. We will meet again with another interesting topic. Till then, stay safe and stay happy.